Well, joining us more is Kyle Ryder from Capital.com. Kyle, a good Monday morning to you. Let's first start in the States on Friday, that key non-farm payrolls report. Weaker than expected.
Weaker than expected, but due to distortion. So the markets kind of looked through the data more or less. We had sort of 12,000 jobs added to the US economy in October, which obviously on the surface of things, was a level of sticker shock for the market. But diving into the detail, it was clearly because of the major hurricane events that we saw through the month. And as a result, we saw a fairly negligible move in the markets, especially equities, which actually edged higher, which of course was sort of defined the trend of recent jobs releases, which were very much responding to strength or weakness on the basis of what it said about future earnings and what have you. So we're going now into this sort of Fed decision on Thursday morning our time, where the dial hasn't shifted meaningfully as far as what is expected. 25 basis points is priced into the curve, and then it'll become about the guidance and effectively future jobs data when we can get a better sense of what's actually going on in the underlying labour market. So, unfortunately and perhaps unusually, it was actually quite a limited response to that non-farm payrolls print, again, just because there's so much noise in the data, and then perhaps too because we have so much coming up this week which could sort of drive future outcomes for the labour market.
So, Kyle, to this week, it is a huge week. Let's start first with the US election. Obviously, a great deal of uncertainty there. Impossible to know who's actually going to win this. How are we seeing markets respond to that uncertainty?
Well, I think on the basis of what's expected, markets are pricing in sort of this Trump trade, or have been over the last few weeks. But coming in this morning to the desk and having a look at the aggregate polling as well as the latest market expectations as far as betting markets, there seems to be a slight shift back towards Harris, albeit from position far behind Trump. There was a real move over the last sort of 3 weeks or so in terms of polls in key battleground states, again, as well as betting markets as well towards Trump, and that was being manifested in asset prices as well in financial markets. There was a very great chart that was released, I believe, by someone in Bloomberg, tracking the US 10-year yield versus the implied odds in the betting market of a Trump victory, and it was a very tight correlation. So more or less, the markets are banking on a Trump victory. Arguably, it's one of the reasons why we have seen such strength in equity markets recently, just on the basis that corporate tax cuts are a big part of Trump's agenda in the short term. That's going to be funded by deficits, so that's kind of like a reflationary dynamic, which can be good for company profits, especially for those sort of old economy companies. But again, with this kind of shift that we've seen in the betting markets and some polling, very, very early on in the piece, maybe it's going to be a little bit closer than what the markets and generally speaking pollsters were expecting only a week ago. So highly uncertain, incredibly volatile, and I guess we have the good fortune of being in sort of our Asia market hours when the results start rolling through on Wednesday.
Yeah, that's right. Around 10 a.m. When polls close here on Wednesday morning Eastern time. Kyle, you talk about obviously that Trump trade. What would the expectation be then if Harris wins, or perhaps more critically, if it is a contested and protracted outcome there, just in terms of that result?
Yeah, well, it has to be said that it doesn't seem like the market's really pricing in perhaps a protracted outcome, because obviously this is, I guess you could say, in market terms, asymmetrical. If it's a close Trump victory, it's expected that we won't see the Democrats challenging the result perhaps as vociferously as the Republicans, or at least specifically members of the Trump team, would if it's a close result in favour of Harris. So on the basis that the markets are expecting that Trump will win, there's also the expectation that there won't be, again, such a strong challenge to the overall result if it happens to occur. However, and you can see that in market pricing, because the VIX curve, you can really see that the implied volatilities drop quite significantly going into the kind of middle months of the VIX term structure, December, January, February, which suggests again that the result could take a few days to reach, because it is expected to be rather close, but it won't be something that drags on and on, perhaps like a Gore-Bush situation, it's perhaps close to a month until we get a result. Nevertheless, if Trump happens to lose, there'll be two factors there. There'll be the extended volatility because the expectation that perhaps there won't be a clear result, and there'll be challenges to the election results as well. And then you also unwind the Trump trade, which is, again, that corporate tax cut trade and that trade on greater deficit spending, which was expected to bolster company earnings. There's also the argument, too, that perhaps not just because of higher corporate taxes, but because of also antitrust legislation and things like that in the tech space, that Harris wouldn't be great for the equity market there either. So the other element to layer over that too is what happens in terms of the congressional race, whether there'll be sort of a split in terms of the balance of power. Generally speaking, the kind of view is that, rule of thumb is that the market's like a divided Congress, because it means it sort of tempers the excesses of both sides of politics and also creates a more stagnant environment, which means that more or less adds to more predictability because no big legislative changes can go through. A lot of layers there to unpack, obviously. But overall, if Trump doesn't win, there's probably a little bit of downside risk to those Trump trades, which is, long yields at the back end starting to come down, gold prices maybe coming down a little bit, the US dollar coming down a little bit, old economy stocks coming down a little bit. That's the immediate reaction. But again, if it gets challenged, it could drag out a little bit. The makeup of Congress also matters. So a lot of moving parts at play.
Indeed, there are. And Kyle, of course, earnings season, meanwhile, continues. That was a big week last week, rounded out there by Amazon, which had a positive result. Of course, the focus for the week was on that AI spend, which has concerned investors.
Yeah, and I mean, if you had to sort of put a grade on it, or a pass-fail, just on the AI thematic alone, not the whole overall tech results because they were mixed, but overall just on that AI thematic, you'd probably give it a slight fail, really on the basis that, like you said, there is this assessment of the balance of, investment in artificial intelligence and the return on that investment. And there is overall this perception that perhaps there is a level of overinvestment going on and that the returns aren't there yet, at least not so much from this kind of binary too much, too little, but more that, compared to what's being priced into the markets, the return isn't there on investors that perhaps they were hoping for, Microsoft being the best example of that in terms of its results. So that could be an underlying thematic for a few quarters now, because we had that kind of, very much a big boost in sentiment from the beginning of AI. We then had that, big investment period where everyone was sort of wanting to see signs that these companies were investing heavily in artificial intelligence, but we've turned the corner there and now looking for, obviously return on investment. That has been not as high as perhaps a lot of investors were hoping for, again, at least relative to valuations. And as a result, we saw that sort of choppy price action for tech results last week. It has to be said, I mean, the results overall seem to be enough to have pushed the blended aggregate earnings estimate for the S&P 500 at a little higher than where it was about a week ago. We're looking at sort of mid-single-digit earnings growth now from sort of low sort of single-digit earnings growth probably a couple of weeks ago. So that's overall a good thing, and the strong results from for example Amazon last week were a large reason for that. But again, overall there's this kind of mixed, tepid response to some of the AI narrative, and that's going to be a story I think that sort of sticks around for a few quarters now, because obviously it's very much a sort of a secular sort of mega trend playing out for us.
And Kyle, just to round out the week, of course, locally, we get the Reserve Bank meeting tomorrow. Expectations it's going to remain on hold. Interesting to see how it just interprets that latest data, though.
Yeah, it will be, and they'll obviously emphasise the underlying inflation measures because on the surface of things, we do have the headline inflation rate back between 2 to 3%, but of course, as we are well aware, that's due to the impacts of subsidies to households for energy and what have you, and the RBA has expressed that that's not its priority. When it comes to assessing inflation, it wants to look at more of those underlying measures and how that's kind of trending within the economy. As we said, it's trending in a positive direction. It looks like we have seen, after that kind of blip and lift again in inflation over most of the course of this year, actually, that it is starting to move lower, but it still has a 3 in front of it. And you would imagine, considering that the RBA is sort of framing the inflation story very much around supply side issues rather than demand, because obviously demand is weak, and on the surface of things, if you just isolated demand, you'd say, well, inflation ought to be coming down, because as we saw in retail sales and what have you, pretty underwhelming overall. Growth is only really just hanging on into positive territory. Supply is sticky. It's still out of balance with demand. Ergo, there are still risks to the upside to inflation. The RBA will probably want to remain vigilant as a result. So the market's now pricing in that there will be a cut still as the next move. It will be at some point between the start and the middle of next year. But the real conversation will be about the potential timing of that and whether there's any kind of change in the RBA's rhetoric about its balance of risks to the economy. The whole ruling anything in or out is that kind of key phrase. It doesn't look like it'll change. It'll probably be steady as she goes for that one. Back to the data and data dependent from there.